Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, May 23rd, 5:41 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in an uptrend led by large caps, more specifically large cap tech, but the Titan 25 is hanging in there. We'll take a look at that since it's Titan 25 Tuesday. And still trying to avoid commercial real estate and regional banks. Regional banks actually acted okay today. In fact, the second straight day that they've been up today was actually led by the two weakest sectors, oil and banks. Let's check the trend gauge over here. Market leaders, green uptrend, yellow sub arrow, a little bit of weakness today, but that weakness was in the overall market. Short term, in an uptrend, three of the five major indexes above their 21-day moving average. Mid cap slipped back below today. The Dow has been weak recently, so we've got the yellow sub arrow there also. Medium term, three indexes now with at least 1 day below the 50-day moving average. S&P and NASDAQ 100 continue to lead above it, so that's neutral long term. S&P, NASDAQ 100, and the Dow above their 200-day moving average, small caps and mid caps struggling below. So what happened today? If you look at these numbers, they look pretty harsh. It's very red, but after looking under the hood, I think that it just feels worse than it really did, because then all we really ended up doing in the S&P was pulling back to test that recent breakout from that tight 8-day range that we were in, and that's pretty much where we bounce. Now, it doesn't give us a lot of room for more downside, excuse me, before we would violate that, but we'll leave that for tomorrow and the rest of the week. Here are the numbers. I included the Titan 25 composite to support my statement that it wasn't as harsh as it feels. They were on average down 0.72%. That's nothing to get overly concerned about. The 21 over 21, I added this today also to reflect that leaders did underperform today, down 1.7%. The RG7, this is our 7 growth ETF composite, down 1.45%. S&P down 1.12. NASDAQ 100 down 1.3. Dow down 0.7. Mid caps down 1%. Russell 2000 led all day, was green most of the day, faded late, down 0.43%. Global diversified 60/40 stock and bond down 0.75%. This was all on the stock side. Global combined, the 60% global stocks down 1.26% on the day, but bonds were flat. It's a 60/40 portfolio, so the net is down 0.75. In-house GROTECTION down 1.27%. We'll talk about what outperformed and what underperformed today. And then we'll hit the charts, including Titan 25 Tuesday, taking a look at these big caps. If they don't break down, the indexes can't break down. So let's get into the S&P 500 here. And you can see after 2 days up, we had a tight 2-day consolidation. We're still inside that breakout level. So make this a 3-day consolidation, even though this was a pretty harsh down day. Let's take a look at this on a 30-minute chart and draw a couple of lines here. So here is the tight range that we had, that we broke out of on the 17th. That's the top of the range. Obviously, the bottom of the range down here around the 4,100 area. So one day we broke out on the 17th. We had another up day on the 18th, started to consolidate on the 19th, continued the tight consolidation yesterday, and then the down day today that came down. Really, this is a range. It's not a tight level. The last couple of days, it's really, 41.40 to 41.54-ish. So that's where we settled today. Now, what the bulls don't want to see is a move back down into this level here. Uh, but it still would be normal it would just be a failed breakout, but back into the prior range. Now, if we get below this level, 4,100, then we've got something else to talk about, because then we very clearly failed the breakout, and we've got to look at this level down here, which is the 4,000 to the 4080 level, to see what the next leg down is, and we'll be getting more defensive should that happen. You can see the bottom of this support level is around 40.40 to 40.50. But when we broke above, it was around here. So 4,100 to 4080-ish at the worst on any pullback. A break much below today's lows would be a failed breakout. The bulls are very clearly wanting a bounce here. The bears are saying, we told you, but they you just, I mean, bears are perma bears especially are just hard to handle. I do want to note we're extremely oversold on the 60 minute. So let's take a look at the last couple of times we were oversold on the 60 minute. This does not guarantee anything, but all we ever do is try to put the odds in our favor. Last time we were oversold, we bounced. Here we are oversold again. We went sideways, then broke down, and then bounced hard from this one. Here was another bounce. Let's see. Last time we got close to it here, these were false breakouts from this level, trying to move out above this 41.40 to 41.50 level. We couldn't do it. And then finally we got oversold on the overbought on the 60 minute, very normal. And we're here again. So you can hang out in here for a couple of days. You can go lower while you're underneath there, as you can see by comparing this area. And you can go from oversold out of oversold area and not really make much progress, because it's a 14 period look back. And the question is, what's actually going on right now compared to where we were? So that's your 60-minute stochastic. Let's get back to the daily chart here. And we're also sitting right on the 21-day exponential moving average. So that provides an additional level of support, as well as that support at the top of that recent range that we broke out of. Let's move on to the NASDAQ 100. A test of a pivot is a very normal occurrence on the S&P 500. Now, one of the reasons why we might have a further test, and if we do and we don't have some serious rotation into other indexes and other sectors, it could look worse, is because we haven't really come anywhere near ready to test the breakout on the NASDAQ 100, because the big tech has been dominating so much. We can still pull back to this 325-ish level. That's about another 2.5%. And if that happens, the pain might be felt on the S&P 500. You can see on a relative basis how the NASDAQ 100 went from underperforming to very much outperforming. Now it's been kind of in line over the last 3 sessions with the S&P 500. It certainly needs to take a break. We got pretty extended above the 50-day moving average at yesterday's close. I should have noted that. I saw it but didn't mention it. But 6.5% above the 50-day moving average is when you start getting concerned about a pullback. The normal amount that you get stretched is between 6 and 7% before you're ready for some type of pullback. So ideally, we just go sideways here now. The slope of the 50-day moving average is pretty steep, and we just let that line catch up to price on the NASDAQ 100 to avoid any additional pain. Dow Jones Industrial Average has been lagging, bounced up a little bit on a relative basis, but did break the 50-day moving average today, but is still above the 200-day moving average. MDY mid caps struggling at resistance at the 200-day moving average here. You've also got the 8, the 21, and the 50 all clustered up there. I mentioned yesterday how bulls wanted to see a clean breakout from this level. We got really just the opposite today. IWM small caps led early, ran into the declining 200-day moving average, and that was it for that on the day. Although we did note the relative strength outperformance on small caps. Let's look at KRE. This was responsible for a lot of the damage. Note the relative strength on KRE, KBE. This is banks with a bigger slant. Relative strength there also. How about XLF, the overall broad financial sector? Not much relative strength there, but that means that it's other uh, companies that are inside the financial realm, like Visa, that didn't have a good day today, gapping down and finishing near the low of its range, down 2.9%, as Citigroup came out with some recent credit card data and said that consumers appeared to pull back spending recently. And one of the culprits for that was they mentioned that restaurants hadn't seen as much spending, and we own CMG, and that pulled back today. We'll take a look at that shortly. So let's move on to, let's start out with the VIX. As you could tell, on a down day with the market, the VIX was up 7.7% above the 21-day moving average. That's a negative, ran into the declining 50-day moving average. Again, this is kind of a normal move for the VIX. Actually, it's stronger than you ordinarily would have expected if you were just comparing where it would be relative to testing the pivot from the breakout, because that's this level here, but we're all the way up here, and add in the debt ceiling crisis factor to that. That's adding some additional volatility and fear into that equation. Here's the dollar, continues its trek higher. Not good for stocks, not good for precious metals, but gold, maybe a little bit of a fear trade into gold today, was up mildly. Gold stocks, however, continue lower, down 0.7%. Silver, SLV, down 0.7, lower also. Bitcoin was strong early, still finished up 1.2%, but still below that 16 level, which was the bottom part of the range that it broke down from a couple of weeks ago. Let's go to bonds now. Bonds started out to the downside, undercut recent lows, put in a hammer as fear came into the market. Money flowed into bonds, bidding the prices up and bringing the yield down. Not a surprise that it happened right here. You can see we're oversold on bonds. That's the broad bond index, TLT. We're oversold there. These are really due for a bounce. Came all the way down to 100. This was that false breakdown level that happened back at the end of February. Let's go to yields now. The 30-year TNX reversed where at that spot where we had this abandoned baby false breakout and then breakdown back into the range. TNX 10-year made a higher high in reverse, nowhere near that failed breakout back in February. What's left? Is that everything? We did the dollar, we did the VIX, we did the precious metals. That is everything. So let's get to the tail of the tape here. You can pause this. I'll hit the highlights. There's the big jump up in the VIX. The news, the headlines were dominated by debt ceiling negotiation nonsense. The markets are getting sick of it. I know the average American is getting sick of it too. Up to with 2 consolidations to up to with 3 consolidations. First close below the 80 EMA, fifth above the 21 EMA. We're Staying positive in our expectations as long as the S&P and the Nasdaq hold above the 21, and frankly the leaders hold up and the Titan 25 holds up, and they have so far. The action today, uh, let's go to it on a 5-minute chart. We didn't really discuss this. So there's the gap down. We tried to rally. We based for like 3 hours, and then at 12:30 we had one leg down, bounced again, another leg down, uh, bounced again, the third leg down, and then we just chopped into the close. One thing I didn't like is that when we tried to rally up, this we failed at this 41.55. That's a fib level that we have noted on here. That's the 50% fib of the 2022 bear market. That has played a somewhat critical role as capping advances, as you can see in here and over this way. Um, so I would have preferred to close back above that, but this 41.40 is more important if you're looking at a nearer term for support. 10 out of 11 sectors down today. One sector that we have been watching with some somewhat high hopes on was medical equipment and devices. This is a an ETF that had been pulling back, got over sold, looked like it was bouncing off the 50-day moving average and trying to get above the 21. There are some decent looking charts in here, including Intuitive Surgical, which is in the 21 over 21, but that really broke down today. These are the types of things you don't like to see, and if they continue and don't bounce, this can lead to more downside. But for now, we're concentrating on the overall indexes. It's possible that oversold staples rotates out of tech and into that, into oil, which has been weak, and continues into the financials, which have been weak. And we just have a big rotation in the S&P 500 while the Nasdaq 100 rests. That's certainly a possibility because we're getting very oversold on some of these indexes that have been weak, including staples. You can see it breaking the 50-day moving average today. On the strong side, as I said, oils, regional banks, biotech, the dollar. So in-house, we added Tesla today early. It's been continued to show some strength, and it's something that we want to. It was a little bit extended when we bought it, but I really liked the volume that it had been showing, and then it reversed. But the starter position was only 1.5%, and we can weather that very easily, weather the pullback to the 50-day moving average very easily with that. On the other hand, um, retail continues to weaken, and add ELF into that. It couldn't hold the 50-day moving average today, so we sold the rest of our position for a 5% loss, and this has earnings tomorrow, so no cushion, no good. And then sometimes you buy something and it looks good and it just doesn't work, and you just gotta admit that you were wrong and get out. And that's the case with Shopify today. So this had a very nice 3-day, look at the volume on this, very nice, perfect 3-day move up off of its earnings gap, and then it started pulling back on very light volume, just the way it's supposed to, declining volume, started to bottom, volume got really tight, and then yesterday, uh, right off the ADMA, right off the oversold 60-minute stochastic. It gapped up in the morning, showed extreme strength, but all that was completely undone today on higher volume. Here's, well, it wasn't a gap up, but it was right off of that 60-minute oversold stochastic, extreme strength in the morning, huge volume. We bought and then we added, had up to a 4% position. It kind of went sideways, didn't really like the close, but that was how the market closed. Then today, a little bit of a gap down along with the market, rallied up to flat while the market didn't. So far, so good there. But then just all of a sudden, that quick, like at 12 o'clock when the market began its first leg down, we just saw selling with volume on Shopify. We sold half of it, and where it after it sold half of it around this area, it bounced. The market started lower again, and we sold the rest of it into the close. About a 0.2% loss on this, which is on a 4% position, which is where we try to keep our losses minimized too. And like I said, sometimes they work and sometimes they just don't. And this one just didn't. And it's a fact of trading. and you have to admit when you're wrong instead of taking big losses. So we cut that, uh, pulled back. So our overall exposure reduced some today with those two sells. The bottom line, normal pullback feels bad, but it's just a retest of a breakout. That's what I'm sticking with until we get, that's my interpretation of the market until we get more evidence to the contrary. And speaking of evidence and the Titan 25, here is our interpretation of the data. Actually, it's not interpretation; it's a fact. Here's where these 25 are relative to their 21-day moving average and their 50-day moving average. Are they improving? Are they getting worse? Are they extremely concerning? Or are they just something we want to keep a close eye on? Now, the thing that jumps out is that we've gotten much worse relative to the 21-day moving average, as we've now got uh, 7 below, 2% or more below their 21-day moving average. Now, you got to allow a stock to pull back below its 21-day moving average. You consider this more of a warning. And then if it starts to seriously break below its 50-day moving average, that's more than a warning. That's something you need to pay extreme attention to. And right now, the only stock that fits that criteria out of the top 25 is Amgen, a big cap bio stock who recently had a merger scuttled, and it hasn't reacted well, and it hasn't acted well. But you can see we've still got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 of the 25, at least 3% above their 50-day moving average, only one below, 4 within 2 to 4% below their 50-day moving average, and the other in a range that we consider acceptable, which is less than 2% below and no more than 1% above. So that's kind of the buffer that we give it. And this supports what we're seeing with the overall S&P 500 now. You'll notice what it also supports is the weakness in the Dow Jones Industrial Average. These 13 stocks that have percentages here represent 64% of the overall Dow. You can see how heavy the weights are on these, and you can also see where they are. They're much weaker than these big tech stocks that are at the top. And if they start to weaken, then the S&P and the NASDAQ will weaken, and we'll obviously get more defensive, and it'll be telling us why, what sectors to avoid, what sectors are holding up, and will provide input into the next move that we're going to take as far as whether we're going to get more defensive, or if, on the other hand, if we hold right here, this is a very, on the S&P, this is a very low risk entry for a long, bouncing on a pullback to a big pivot of a consolidation where we broke out of, and also right above the 21-day exponential moving average. So we're at a low risk situation there with the S&P. The Dow look terrible. The Titan 25 is holding up fine, some better than others, but until we start to really break down and the big 25 stocks start to totally break down, we're going to give the market the benefit of the doubt, and as always, paying attention to what's going on with the leading stocks in the leading sector. So you can freeze it here if you're interested in, this is kind of the trend or where they are relative to a blend of the trend and where they are relative to the 21 and the 50, and it's just a stoplight. It's either positive, it's neutral, or it's negative. As I said, 7 of them have worse this week. 1 has improved. That's Home Depot, which ironically, along with Lowe's, reported low average earnings. Lowe's reported, this is where it originally gapped down, and here's where Home Depot is now. So it's not all um, negative for retail, and it could be that weakness for Home Depot and Lowe's was what was built in to this pullback from 340 all the way back to 280. Lowe's lowered their guidance today, but ended up 1.7% and holding the 2-day moving average. Here's where they initially gapped down Home Depot's earnings, and here's where they are now. So the reaction is important. Um, and again, this pullback may have been what was foreshadowing the slowdown in lows. Now, I am a little bit more concerned about what's happening with some of these consumer stocks, such as Lululemon, which we stopped out of uh, on Friday. Chipotle, I don't like the pullback here today after the nice gap up yesterday, breaking the 80 EMA, but we're still above the 21, still in line. Yeah, it means it's a failed breakout above 2077. Our second buy is just mildly underwater. We're watching that, and we'll hold the plug on that if we need to. So let's take a quick trip through the rest of the portfolio, and we'll decide how they act today relative to the overall index, and did they outperform or underperform. You always want to know what are your stallions and what are your donkeys. So Chipotle, as I mentioned, our biggest position down 2.61% on the day. This and Shopify were responsible for the monster share of the losses in the portfolio today. So there's CMD, Uber, um, still above the 80 and down 1.3%. Anytime a growth stock is down in line with what the market did, it's really uh, doing better because it's got a higher beta, it's got a higher ATR, and it just in line with the market's doing. That's a win because we know these stocks can outperform 2 to 3 times on the upside. They also can do that on the downside. The VIA continues to rest after we took some off last week when it got just ridiculously extended. But this pulling back, and they've got earnings tomorrow, and that's going to be huge after the close. Pulling back on lighter volume is exactly what you want to see with this. Nothing wrong with that. DT broke above 50 today, reversed along with the market. This is showing relative strength with the market. So only down 0.5%. That's one of the stallions. Uh, Let me hit the mute button there. Okay. Celsius continues to just kind of really go sideways to up, pulled back to the 8 today. Volume has been heavy, which is not exactly what I'd want to see, but there's nothing wrong with this action after a big volume breakout today, down 1.23%, basically in line with the market. Shopify, we showed how that just didn't get it done. We cut that. Elf, earnings tomorrow, broke the 21, broke the 50. Didn't get it done. We cut that yesterday and today. AMD actually positive on the day, very clearly one of the stallions, although it did close in the low of the range. We still have Microsoft, which down 1.8%, a little more than the market, but after what the relative strength's been doing, and it's still holding the ADMA, there's nothing wrong with that. Tesla, we took that initial position today on the additional strength. It pulled back. Volume was heavier today, but the volume was heavy 3 of the 4 days where we just showed good price action after last Tuesday's shareholder meeting. So we'll pull back for Tesla, and finally Meta, the last position, down 0.64% on the day, continuing to show relative strength. So that's a review of the Titan 25 in the portfolio in the face of a market pullback, and the bottom line is our interpretation is that the pullback to the breakout pivot feels a little worse than it actually did. Pulling back to the pivot on a breakout like we did on the S&P is completely normal. Although being down over 1% on the day, we've recently shrank the ATR on the S&P 500 to 1%. So that's another reason why, after all the tight ranges, that it feels a little bit worse than it did. And that's why we do what we do here at Revere, protecting the downside, interpreting the market, taking uh, action based on the interpretation, getting out of the way of hard markets, and then the market gets to a healthy posture, which it has been, not broadly because of the oils being weak. When oils and banks are weak, there are a lot of companies, and when you count one in advanced decline, it counts the same as whether or not Apple or uh, Chipotle or NVIDIA was up or down. So you got to pay attention to the advanced decline line. will lag when small caps are lagging, and it will lead when small caps are leading. So that's our take on the market. If you're interested in this approach, I'll wrap it up by saying, and reach out to me, Don at RevereAsset.com, or my partner, Dan Stewart, Dan at RevereAsset.com, or call 855 Real Wealth. That's 855-732-5932. So wrapping up Tuesday, May 23rd. This is Don Vandenbord, telling like it is, just the facts, just the market facts here at Revere. You might not always like them, but you can't argue with them. And if you can, drop me a line and we'll discuss what I'm seeing versus what you're seeing. And I'd be glad to hash it out. So that'll wrap it. Thanks for listening. Have a great day.